Good afternoon, and welcome to Hong Kong Green Finance Association's webinar on unlocking adaptation finance and building climate resilience through insurance. My name is Chen Chen. I'm the Secretary General of HKGFA, and I'm delighted to be introducing our distinguished speakers today, hailing from the insurance and real estate sectors, who will share their considerable knowledge and experience and approaches to adaptation finance and climate resilience. Before we start, a couple of quick housekeeping matters. If you have any questions, please feel free to provide them in the chat box. There will also be a survey at the end, so please feel free to complete that as well. We have a very packed agenda, so let's kick off with the inimitable Deborah Tan of CWR, who will set the scene with the adaptation opportunities from irreversible fast rising seas. Deb, over to you.
Oh, thank you, Jen, for that kind introduction. Right, he's here today sharing on the inevitable adaptation investment opportunities due to fast rising seas and obviously coastal threats, but we don't need to look too far because storm surges are here today already. Oops, issue. Right. I think, we're all familiar with climate risks. This is just in the first quarter of 2025. We have floods, fires, storms, even snow in Florida. So I think last year Swiss Re had Nat Cat losses at 381 billion, of which 57% was uninsured. And I think just on this page alone, we have at least $100 billion of losses, and we're just not even just about halfway through the year, but this is just the first quarter. So the hotter we are, the more risks will be. And water is primarily how we'll feel climate change. So hotter equals more water risks. And we are getting hotter. Just for an example, 2022 was 1.15. In 2023, we jumped up to 1.45 degrees. In 2024, we're at 1.55 degrees. So actually there's an 80% chance of reaching 1.5 degrees. And so this is on a decadal basis. So over 10 years, average 1.5 degrees somewhere between now and 2028. And there's a 97% chance that we'll actually reach 2 degrees by 2100. So that's pretty much almost certain on our current climate path. This puts us at a tipping point for ice, because 2 degrees is way too hot for ice. We would actually lock in a 1 meter of sea level rise from mountain glaciers and thermal expansion of our oceans, 3 to 5 meters of sea level rise from West Antarctica ice sheet, and 7 meters of sea level rise from the Greenland ice sheet. Now, the Greenland ice sheet is quite sensitive, about 1.7 degrees, but today, a new study has just come out saying that 1.5 degrees is too hot for ice sheets. And there is a 10 to 30% chance of reaching 2 degrees in the next 20 years or so. So we are really at risk of triggering these. Another study has just come out this week because in the last few days was the global meeting for glaciers in Tajikistan, and this is the first of its kind, basically sort of saying that 1.5 degrees is also too hot for glaciers, and we need to sort of stay within 1 degree. So the only way to stop this is rapid decarbonization to slow down these fast rising seas. There is no other undo button. Why is this important? Because ice or the cryospheres actually represents 2/3 of our planetary tipping points, but yet it's not really represented in TCFD or TNFD or any of the FDs. So, and we must move to stop the melt, because we've actually lost 14 trillion tons of ice in the last 30 years. This translates to about 50 million tons of ice lost every hour for the last 30 years. That is a lot of ice. And really, so adaptation to fast rising seas is inevitable because the rate of sea level rise as a result of this ice loss has already doubled. So if you're interested in this, I highly suggest that you look at the 13 fact sheet guide that we produced with some top global and national Chinese scientists from China on how to stop the melt and, quick facts. They're quite horrifying, so full disclosure. But this means that 1.9 meters of sea level rise by 2100 is now very likely. So this means that the cannot be ruled out scenario highlighted in the IPCC that will make Hong Kong look like this by 2100 is more likely than not. But yet we still have zero mention of adaptation in our policy address, which means that if we're not adapted, this could mean to higher risks. And obviously, if Hong Kong looks like this, then the failure to adapt will mean systemic shocks for banks, as well as the real estate sector and insurance sectors as well, which is why we're all here. But obviously, this creates opportunities, and escalating risks results in adaptation markets. So we're really looking at 1 trillion of US dollars from adaptation-related products and services, and this is revenues today. This is by a study by the London Stock Exchange Group. GIC just released a study last month looking at $4 trillion of revenues from adaptation investments, and they literally just sized 21 solution areas. So this is a limited study and a conservative estimates. But if we don't do anything, JP Morgan puts losses per year at over $1 trillion as well. And this is just from large corporates only. And basically, the quote here, according to the report, is that maintaining status quo without adaptation will destroy value. So these 21 solution areas, this does not include sea level rise, and obviously adapting for storm surges and typhoons and occasional event flooding is very different from adapting for a chronic or permanent risk. Singapore's upped its coastal defense funds by 5 billion, so that's bringing it to 10 billion Singapore dollars, but it should be 100 billion plus Singapore dollars by the end of 2100. And Singapore just has a 200-kilometer plus coastline. So you could imagine for the whole of Asia what the upside would be. So the question here is, how can Hong Kong create this adaptation market and also capture it at the same time? And what's the role of real estate and insurance? So we could take a quick look at Hong Kong developers on adaptation. So we had a report that was out asking these 3 questions. Do they have a good grasp of physical risks? Do they have adaptation strategies in place, and are they transitioning to slow down physical risks? And this is Chung Kong, Henderson, New World, and Sun and Gay with lots of assets in place. And we found gaps in physical recognition amongst themselves. So Chung Kong will say that I have very high risks. Henderson only actually stress tested for storm surge and not for sea level rise. And New World and Sun and Gay said they didn't have any risks at all. So clearly there's something wrong there because their properties are almost next door to each other. So we stress tested ourselves for all their properties, 900 plus mainland China and Hong Kong properties, and we found that actually all of them have similar exposure to risks. And so actually only Sun and Gay matched our disclosure. So if you look at, sorry, not Sun and Gay, only Chung Kong matched our disclosure, and Sun and Gay is the worst. So Chung Kong, 40% of their properties, or 31 to 40%, will face storm surge risk today, whereas by 2100, a third of their assets, almost a third of the assets, will be underwater. Henderson didn't stress test for sea level rise, so it could be blind to that sea level rise risk. New World looked best on paper, but clearly it's right off the mark of what they've disclosed, so they're probably let down by the climate tools they're using. And bear in mind that this 18% of permanent submersion could occur by 2070 or as early as 2050 if ice sheets continue to melt fast. Of the 4, Sun and Gay is the most exposed, but it said it had very little risk, and this is most likely because it only stress tested 8 properties. So not assessing for physical climate risks properly means that you could miss out on the opportunity to adapt and capture that upside and also reduce your risks. So other sensible tests we carried out was to sort of see if the existing properties versus property under development would be different, and you would expect properties under development to show less risk. And this was certainly not the case. This is the case for everybody, but for New World. And on the sensible stress test 3 to see if they were actually cutting emissions, you can sort of see that everyone's emissions are actually still going up, which means rising risks. So technically all in, they each have no sense climate strategies, and this could reach material write-downs. If you're interested, you could look at the fact sheets each. But these risk gaps highlight opportunities, and one, there's a clear market for sustainability-linked insurance as demonstrated by Link's actions. and proactive actions could sort of like bring you upsides and also reduce risks. And insurers can therefore actually unlock flood resilience in coastal defense markets from salt waterproof or fireproof construction materials, infrastructure, flood infrastructure, pumps, or other nature-based solutions. And, I think the gaps highlighted by us really shows that we really need a local and regional chronic climate risk intelligence and to stress test at the high end of the range. Also, there are benchmarking challenges because disclosure was all over the place, different scenarios and so on. So there's a standardization possibility. And in the end, adaptation materials can also be very carbon intensive. And so can we actually create markets for less carbon intensive materials, so low carbon steel, cement, and so forth. I will stop here because I think that Hong Kong is uniquely positioned to create this adaptation industry and capture this upside. We had a newsletter on this. But actually to sort of see this, we need to sort of like appreciate the risks. I'll stop there. Thanks.
Thank you, Deb. Always thought-provoking, and I encourage you all of you to please check out CWR's website. There's a lot of incredible research there. Thank you again for highlighting the opportunities through that 1 to 4 trillion opportunities, as well as the challenges which property developers face here in Hong Kong. Now I'd like to invite Dr. Calvin Kwan of Link Asset Management, who's absolutely no stranger to some of these risks. Calvin's going to share with us how Link worked with their insurance teams to create pilot solutions which actively reward climate adaptation investments and actions. Calvin, the screen is yours.
Sure, thank you very much. So let me just share screen here, and you should be able to see my screen now. Good. All right. So thank you very much for the opportunity to share a little bit. I think in the last couple of months, we've been talking a lot about climate resilience, what actions that we have, and I'd like to share a little bit of our approach to climate resilience. It's just a pilot project. But before I go further, I do want to highlight that what I'm sharing here is nothing really extraordinary. I believe a lot of organizations are already doing what we've highlighted here. There may be one extra step that may be slightly new, and that may be able to help create additional value. Before I go further, I do want to explain a little bit about how Link looks at sustainability. Our efforts really focus on 2 key areas. One, initiatives should be focused on preserving and protecting the value of the current portfolio that we're managing. Or number 2, it helps to create new value. When we're looking at climate resilience, I think that really focuses on preserving and protecting value that we have at this point in time. So it goes without saying, as what Deborah has presented, extreme weather events are an operational reality. Just over almost 2 years ago, some of you have probably seen this photo, or at least you'll remember this. September 2023, Hong Kong was hit by, I think, a typhoon and then black rainstorm within a matter of 5 or 6 days. This is our Temple Mall, and it was flooded up to about 2.5, 3 meters high in that particular area. Now, from this, we really had to sit back and go, how do we deal with this? In the most conventional situations, the response would simply be this, right? Drain the place, clean it up, file some claims, absorb some of the losses that will inevitably occur, and then get ready for the insurance side to give premium hikes. What we decided to do is figure out, wait, how might we break this cycle? What could we do differently? So we chose a different approach. What we wanted to do is actually to present quantifiable evidence of how we're able to reduce risks when we're looking at resilience-focused efforts. So when I said earlier that I think a lot of organizations are already doing this, how do you put in place floodgates, cleaning up the pipes, install water sensors and so forth. I think a lot of us are trying that already. But what we then did was actually do a ESG roadshow to let insurers know what we actually did. It's not just enough to say that we did it. This is actually one of the slides that we present, which quantifies the efforts that we do on flood risks. So if I start at the very top left side, we're running typhoon drills and conducting this across the entire portfolio so that we know the teams can respond quickly in the event of heavy rain or typhoons coming in. Again, things that we're already doing. We then actually installed floodgates at high-risk locations. So we did an assessment of our portfolio, identified about 20 properties which are at risk for floods. And then specifically, we knew where those properties would be at risk for, and then installed floodgates. Again, this is something that most organizations have done. But what we did further is actually to quantify how effective these floodgates should be. So the photo I showed you earlier about that flooding, well, we took that time frame. So we were able to quantify how much rain was falling at that particular time, for how long, and quantify the volume of rain that would come through. And we were able to say, hey, after we've installed this flood barrier at Temple Mall, that same amount of water that you saw before, we would be able to withhold that for about 40 minutes. So then therefore preventing flooding from inside the property. Moving down to 260, this is the number of sensors that we've installed in terms of helping us find leaks and issues quickly. We looked at drainage efficiency, and this is actually quantifying that by simply looking at our drain designs and redesigning them, we're actually able to increase the efficiency of our drainage by over 150%. So this is on top of the additional 40 minutes of protection that we have from flooding as well. All of these information, coupled with some of the points on the right-hand side, we communicated this back to the insurance team. We wanted to understand a little bit more about how we're able to reduce that risk, and therefore how do we communicate to the insurance side we've been able to reduce this risk as well. But before we did that, we did work with an insurance company, in this situation, AXA, to start looking at how might sustainability-linked insurance work through this. And this is all available in that document that Deborah sent out earlier, and I'll have a QR code that you can download the document as well. Now, during this process, what we worked on was we completed a comprehensive assessment of our portfolio. In this situation, we only looked at the top income producing properties first, simply just to prioritize which ones we should be looking at, and then considered what are the key climate risks. Now, for most of our properties, primarily in Singapore, Hong Kong, mainland China, the key risk was actually flooding, right? Typhoons, heavy rainstorms coming through. And from a risk perspective, I think that that's actually very good, because we're already well equipped in these locations to manage those issues. And then going back to the slide I showed you earlier about how do we mitigate these issues. Again, it's about installing floodgates, but not just about number of floodgates, the ability of these floodgates to withstand a certain amount of flooding. We also went through with the insurance company to figure out, hey, what else do we look at from a SOP standpoint, emergency response plan, because we know that flooding doesn't just impact our own property, it impacts tenants, it impacts the communities around us. And how do we put in place an emergency response plan that brings the community together so that we can all respond and channel water into the direction that it should go to prevent any damage to any of our properties. Now, when we did that proof of concept with AXA, we estimated that there would be a reduction of about 10 to 20% in our insurance premiums. So the measures that we implemented that I showed you earlier, I'm pleased to say that when we ran through the ESG Roadshow back in September last year, we were actually able to achieve an 11.7% reduction in our insurance premium. In addition to this, we have another 7.5% that's on the table for us to achieve if we hit additional KPI-linked targets. This is going to be about further investments into flood barrier protection, upgrading our standard operating procedures, and so forth. Lastly, we were also able to increase our sublimit by 2 times as well. And these are all impacting our bottom line, basically from the reduction in premiums that we've been able to achieve. What I do want to highlight, this is a summary, some feedback from some of the insurance companies that were part of that ESG Roadshow. They did appreciate the effort that we made, more importantly in communicating how these efforts are helping to reduce risk. So I said at the very beginning that a lot of you are probably doing this already. Probably the new novel component is being able to communicate that ESG sustainability mitigation effort into that language that the insurance companies appreciate and actually think about. By doing it that way, we make it easier for other organizations to understand how much we've reduced risk by. At the beginning of my presentation, I did say that our sustainability initiatives focus on two things. First, it's about preserving and protecting value in that portfolio we're managing now. And this is a great example of how we've been able to do that. The second component of it is about how do we create additional value. And again, that 11.7% reduction in our insurance premiums is something, new value that we've created. And that demonstrates that climate adaptation doesn't have to just be a defensive approach, but it is a way for us to be able to create additional value. This is an approach that we are working with our property management teams to make sure that they're on board and get them to understand why we have to do more work on the standard operating procedures. How do we track and monitor locations which are flood risks and mitigate those as well. In the end, like I said, we do have a QR code available for you to download the document, and it hopefully will give you some insights into how we approach this. Hopefully you find this actually pretty straightforward and easy to follow as well. And I think that will actually help build up the efforts on the insurance sector in regards to the role that they play in helping companies deal with climate resilience. So with that, Chin, I'll turn the time back over to you.
Thank you, Kelvin, not just for the presentation, but actually all your hard work on this. That 11.7% should really, sort of reduction should really serve, or we should really encourage our audience not just to read that report, and that report's also available on the HKGFA website, but encourage further conversation, whether as a client or an insurance company, to work together to achieve those goals, and also to Link REIT or Link Asset Management, to choose a different approach. Now, to bring this all together, I'm delighted to introduce for our panel. But before I do that, just a reminder that if you have any questions, please submit them in the chat box. On the panel will be Ed Farrelly, Head of Real Estate Practice at Marsh Asia, Hannah Ng, Chief Insurance Manager of MTR Corporation, Deborah Tan, Director and Head of CWR, Candice Wong, Head of Strategy and Planning, Sustainability Officer, CEO Office at Zurich Insurance. And to moderate the expert panel, we have the always excellent Jingwei Jia, Partner at Oliver Wyman and HKGFA's Insurance Workstream Leader. Jingwei, over to you.
Great, thank you. It's a great pleasure to moderate this session today. And we have quite a good panelist. Before I ask the questions, probably to link everything up in terms of the climate change adaptation and also what the roles of insurance. I worked for insurance companies before. I think that's very close to my heart. Climate change jeopardizes the stabilities and also set back the efforts of development. Now we're seeing the increasing frequency and the severity of climate change-driven disasters threaten the lives, the water and the food supply, property, and adaptation is vital to make the society more resilient. And actually, that link to I think it's about taking actions early rather than when the loss happens, then you clean things up. And also to make sure you have the capability of recover quicker and then reducing your vulnerability. And all this actually to do with insurance, where insurance can provide two aspects of protection. Firstly, they provide the flow of capital to support the communities and infrastructure to recover when something happens. And secondly, is really to contribute to the wider understanding of the climate change risks, and we can actually manage before that happens. I think that's also what this panel is about. Let's talk about the exposure in front of us from different perspectives. And also, as Kevin mentioned before, the transparency, the data, the understanding across the industry will only make things better rather than worse. So without overdue, I'll go for a few questions first and welcome any others to ask questions on the chat box, and I can ask questions on your behalf. Without a particular order, I will go for Ed first. You're from the major insurance broking house. and you have seen many risks, many assets in different places. How do the real estate companies across Asia consider climate risks, and what are the key considerations that you have seen from the industry?
Thanks, Jingwei. Yeah, I think this has evolved over time. It's interesting that Calvin noticed a note last night said creation of value. And I think that's really important with risk mitigation measures, but insurance as well as a creation of value. And when we think about risk, insurance is risk transfer, but it's often seen as cost. With real estate companies' approach to insurance, there's a balance between cost and coverage, and it's like you kind of full in. But we look at climate in particular. I think a lot of there is an acceptance of time.
I think
as we've seen,
we're hearing breaking up, right? If I'm not wrong.
Can you hear me now?
Yeah, I think occasionally we can hear you clearly, but don't know why. Can you speak slightly slower so that we can capture your message?
Okay.
Yeah.
Okay.
That sounds good now.
Okay. Sorry
again.
about that. That's a shame, because I said something really, really interesting that you didn't get.
If you could remember. Okay.
Okay.
I'll
rewind. Okay, I'll rewind a little bit. If we look at the efforts that real estate has made on climate risk, I think a lot of that has been focused on really what is my building doing to the environment. So this is the road towards net zero carbon neutral. And that's the focus on transitional risk. So on the road to get there, what are the obstacles that affect? Now, I think one of the reasons for that has been that if you have a green building, it's very easy to quantify the benefits of that. You got higher tenant demand, you got higher rents and lower yields, and that has been quantified. I think on the physical side, what is the environment doing to my building? That's perhaps it has been a little bit more difficult to quantify. Both now, certainly. But going back to the Link's work, and we were the broker for Link and worked closely with Calvin on the project. I remember, Calvin, you may remember this. This goes back a number of years. I think it was you that asked me a question. Well, if a company has poor ESG credentials or poor sustainability credentials, they can be penalized. So, for example, if you have flip the coin over and say, well, if you have good credentials, how can you benefit? Because you should be able to. But if all the action is on transitional risk, that's quite difficult, because what an insurer wants to see, how are you changing the risk profile of an asset? And if you're not focusing on physical side, you're not really moving there. So, and if we think about how insurers view things for a moment, and the insurance industry, the whole property industry, for probably 10 years.
Sorry to interrupt you again. I think the audio is still not really good. Maybe I have to pass on to the next question, maybe. And I think when you lean in towards the computer, normally that sounds better. Maybe we'll get back to you later. But I think I heard you in terms of the physical risks versus transition risk. I think the physical risk is always there. Do not believe the transition risk can be easily fixed, and also that means physical risk wouldn't be there. I think the net cat exposure is getting higher and higher. So I think the company does need to balance that out. And also I think the other message is about quantify the exposure, quantify the measurement, the adaptation. What's the impact that on your exposure that is quantifiable? Then the insurance company can make the assessment. Maybe the next question I go to Hannah. From the MTR's view on fiscal risk, and also how have you managed the risk so far, and with all kind of different tools, and but of course, especially from the insurance perspective.
Sure, thanks, Jimmy. So from MTR point of view, so as insurer, so actually, so we'll try to manage our especially climate risk. So I think as what similar as other corporation like Links and other property developer. So we're not just trying to improve the risk, and we also trying to how to minimize the risk. So I think for the last few years we experienced the typhoon and the black rain. So we trying to upgrade our infrastructure. We upgrade our system, and also we're trying to maybe get more training to the staff, refresh their skills, and make sure that everyone know what to do when there's some risks coming. From the insurance departments, and then we will also do a lot of risk assessment to see what is our high risk, and then we will structure different insurance program to fit our portfolio. Sometimes maybe we will buy excess of loss, sometimes we buy different sublimit. So that is how we manage within the MTR on the property side.
Okay, great. Maybe just a little bit further on that in terms of the insurance program. Have you done similar things that what Calvin just shared before, and also quantify on what you have done so far?
Yes, we did. Yeah, because I think one thing is quite important as insurer is we have to transparent to the insurance market to let them know what we've done. I think because I think within the MTR or the corporation, we definitely did a lot of prevention works. So I think sometimes it will be quite good to have an opportunity to do the roadshow, to show to the market, to different insurer, different panel, to see what we've done, and then what we're trying to minimize the risk. I think that is not just good for insured, good for us, and also it's quite good for the insurance market as well.
Yeah, no, that's a very good point, because actually in the other workshop we did on a similar topic, that was quite a different opinion in terms of how data and the information flow between the industries, right? Real estate to insurance, insurance to real estate. I think there was a weird lack of understanding what the information can be used, and people more reserved on that action. But once you know the ultimate purpose of why insurance company needs data and why real estate needs more calculation understanding from the insurance, I think you would easily achieve the mutual benefit and understand. Thank you. And as we move on, I think it's good to hear from insurance companies. And from the insurance point of view, Kenneth, what is your focus from Zurich, Hong Kong, across Asia, and how do you address the insurers' needs so far?
Okay, thank you, Junwei, for your questions. At Zurich, we're very proud to be the first global insurers to commit to the Paris Agreement, setting an ambitious target of achieving net zero emissions by 2050 across our underwriting portfolio. So that's why we support our clients in managing climate-related risk effectively through a comprehensive approach focused on prevention, protection, and education. By addressing physical and transition risk, Zurich empowers our clients to build resilience and navigate claim complexity successfully. First of all, for prevention, Zurich emphasizes proactive risk management and enabling clients to understand, to reduce, and avoid risks before it materializes. So our strategy includes comprehensive risk assessment. We do detailed evaluations, including the site visit with our clients to identify vulnerabilities to climate-driven threats like floods, heat waves, and typhoons, etc. And with the advanced natural hazard mapping technologies and tools, we can assess client-specific locations and identify areas of significant climate risk. And we also offer risk engineering consultancy service through Zurich Resilience Solutions. There are actually a team of risk engineers and consultants who provide expert guidance to minimize climate risk by enhancing operational practices and providing insight. So we are having a recently launched Climate Spotlight, which is a digital platform which offer automated, simplified climate risk insights tailored to clients' location by utilizing data developed through advanced analytics and machine learning. So through this insight, we can support clients formulate their adaptation strategy by incorporating all these resilience and adaptation measures into their construction plans or claims process to prevent future disruption. For the second part about protection is a very core purpose of the insurers. In the past, we focused on providing insurance coverage for risk assessments. However, I believe our core mission is to protect clients' assets and operations from both ongoing and emerging climate threats has evolved in response to climate change. For example, for the innovative insurance product, Zurich pioneers specialized coverage for sustainable buildings, enabling widespread adoption and financial feasibilities of green innovation. For example, we're trying to develop solutions covering new buildings, methodologies, materials or assets like the solar panels. And we're adopting the Build Back Better initiative. For example, in the UK, we participate in Flood Suisse UK program, providing household clients for flood resilience repair following damages. And for the last piece, for the educations, we prioritize ongoing client education by collaborating directly with clients on transition strategy, sharing industry knowledge, and addressing specific client-related challenges, so therefore enabling them to become client resilient and aligned with global client priorities. So in these three strategy, prevention, protection, and education, we equip the property sector clients with essential knowledge, insights, and tools to manage their physical and transition climate risk.
Okay, thank you, Candice. May I ask a follow-up question? In terms of specific products, you mentioned there are some innovation. I think you mentioned about sustainability, sustainable building. I think Ed mentioned about a green building before. There are different definitions, probably different standard. What are the challenges in terms of coming with all these innovative products? Is there anything you can share?
Yeah, definitely. I think there are a couple of challenges. For example, when the solar panel was not that popular, actually, we lacked the data to understand what risks or how we can protect the infrastructure or properties better, because no one is doing this. Just like when the EV was not available in the first place. Actually, we don't have the data on understanding how to price the risk, so how to protect this asset. So translating this new asset into a pricing model and to provide a coverage for them. So I think there is a learning path for every new technology, materials, or infrastructure to be covered. And secondly is about the knowledge and the talents, whether they are understanding the industries and new technology, how it is helping the entire clients for the transition. So these are the key challenges, I will say.
Okay, great. I can see some of the questions from the chat. I will reserve this for the later part. Maybe I go to Deborah. Hearing all this, and also what you shared at the beginning, there are some huge numbers in terms of the exposure, in terms of what could be the damage size. Of course, to make all this change, adaptation is easy to be said than done. What can be done to motivate more industries to steer and change their actions to adaptation?
Well, that's like the multi-million-dollar question. I think it's a question of risk tolerance, right? I think most of us don't. Most of us are not really proactive in dealing with the risk until we have to. So usually it's when you've been hit with the event or hit with some kind of like loss, then you kind of like, yeah, I'm going to react to this, right? And I think we're generally better also at dealing with one-off event risks like typhoons and so forth. I think we have the expertise and we're dealing quite well with those here in Hong Kong. But it's when it comes to things like sea level rise, we've never really had to cope with these types of risks before, right? And really, it's only the Netherlands that's living below sea levels that has the expertise to sort of like come into play here. So we believe that, you know, there's clearly a lot of people starting to talk about adaptation now. So the risk tolerance level is here. We understand we have to adapt now. And I think the urgency to adapt is even more pressing because we actually realize that, you know, decarbonization has really kind of gone off the tracks. You know, it's like full paused during the Trump era, right? And so I think, you know, with the pedal off the gas on that, risks are just going to sort of rise. It's you know, if you don't have one, you're going to have to do the other. And so if we're not aggressively decarbonizing, then we should be aggressively adapting. So that's one. And you know, unfortunately, here I think, you know, with the slow moving risks, you know, climate change, we deal in averages. When it comes to managing water risks, we have to sort of manage them at the extremes rather than the average. So I think, you know, with Hong Kong, there is a disconnect. We're protecting for sea level rise at the high end scenarios. However, we're using the medium of the range, so the average, rather than the higher end. So, you know, there's a 50% chance that we could get this wrong. So that doesn't provide much comfort when it comes down to adapting. Also, you know, it's great that Link and developers and so forth are also all doing something and TR and so forth. But ultimately, it's going to need collective action because, you know, there are roads that connect us and so forth. And you would need the government to sort of step in. And I think here, it's good to sort of see that, you know, once again, I think we've passed that tipping point. We're seeing the Real Estate Developers Association together with the Hong Kong Federation of Insurers get together with the Business Environment Council of Hong Kong to start dialoguing with the government on these kind of increasing typhoon risks, but also on the more pervasive sea level rise risks. So I think these conversations have started. And, you know, we've recently also seen the government put down 300 million, I think, Hong Kong dollars to up some flood defenses and so forth. But I think if we were really going to talk about proper sea level rise defense to the levels that it could be because of the fast melting ice sheets, we're in for a lot more dollars here. And I think, you know, this is where Hong Kong, where, you know, big risk comes big gains, and we could actually get together and figure out how to finance this as well. That would be the opportunity.
Yeah, no, that's great. I mean, I took out 2 points. One is even with all the work we have been doing, or everyone has been doing in the past few years, decarbonization and all that, you still facing the physical damage, the physical risk right now, and there is urgency to address that. Even if you're on the good path of decarbonization, that will take time for the whole environment to change, right?
Yeah.
At the same time, you need to deal with the risk at hand. I think the other one is we all try to calculate the best we can, and so often we're seeing surprises, especially in the recent years.
I mean, yeah, I'll give you an example. I think we're very good at calculating event risk right now. I mean, which is insurance and so forth, nat cat losses and so forth, and all sorts of loss triangles or whatever. However, you know, at 1 meter of sea level rise, which by scientific consensus, if we continue down our emissions path today, is going to happen by 2070. So this is not 2100, it'll happen in 2070. We would see 70 more days of major floods, right in Hong Kong alone. And right now we have less than 1 day of major floods, you know, maybe less than half a day of major floods. So we're not really seeing any major floods per se, just from normal rains. But if sea levels were to rise to 1 meter, we would see an additional 70 days, right? And minor flooding days will be 350 days. So basically, we'll see floods every single day. And that's much more difficult to mitigate, obviously reduce the risk of. We'll probably have to end up building seawalls and so forth as well, especially when it comes to the multi-meter levels. So seeing that risk is important today because it would urge you to A, decarbonize faster, and B, not throw in investments in areas that would actually be impacted in the long term. I think here it's important to understand that carbon offsets and so forth, unless you're really sucking carbon out of the air, we really need emission cuts. There's no real negotiating with the melting point of ice. And we've basically underestimated how they would behave when it gets hotter by a lot.
Yeah. No, I think that's right. And also that's why an event like this, I know it's a smaller kind of online chat, but to bring everyone come together to have a similar understanding on perception, to have the awareness of what the risk is really about is important. As a consultant, I see problem from different lens, and that happens so often. Let me check with Ed whether your third
Can you hear me now?
will be good. You probably wouldn't like to repeat everything you said 3 times, but still, I mean, from the market point of view, from the understanding awareness, anything you want to add?
Yeah, just very quickly. So if we look at for how insurers view things, just the point I was making earlier about transitional risk, physical risk, it's actually easy to take physical risk to reduce physical risk and improve the risk profile.
Yeah, get closer to the computer. Try one more time. I think your computer
Okay.
worse when you ever say anything to do with risk.
Yeah, this is a Marsh company issue laptop, so perhaps I need to trade it in.
Keep that
is
way.
that any better?
Yes, keep that way. Go
Okay.
ahead.
Okay, so focusing on transitional risk and what the insurer wants to see. The insurer wants to see what is the insurer doing to mitigate risk. And if nothing's happening, there is a cost because insurance premiums will increase. We've seen that. So they're looking for, have risk surveys being carried out? Have the recommendations been acted upon? Have valuations been updated? Are they accurate? And if let me phrase this. I think in real estate, there has been a hesitancy to move on physical risk because it's been seen as beyond the time horizon of an investment by some, and that may be beyond 5 or 8 years. But the impact is being seen now. We are seeing an increase in probable loss. We can measure the financial cost of that. That can be plugged into a cash flow. So we can arrive at a risk-adjusted IRR. So that can go to an investment committee when they're making a stay-go decision on an investment. So because of that, I think we are seeing movement. And again, an example of that was the work that Calvin and Link have done.
Perfect. I think maybe I can quickly summarize what I heard. This is a very important point, that the insurance company want to see actions. They want to see follow-up. They want to see you are delivering the promises. Then this is becoming from 1-year relationship to multi-year relationship. Then that trust will work in terms of how I calculate the premium versus how much you have done, right? And then that will become a supportive events. Whatever you're going to do continuously, I'm going to support further. And the other point you mentioned about this is certain actions, the effect may take years to fully realized. Then there have to be a understanding and a mechanism to be able to award those actions beyond current years. And then the third point I take is insurance company does have data. Right? To talk about all the climate data, insurance company do have a lot of data, also claims data. So if that can be exchanged with certain industry, not only real estate, I think that would be a great value for certain actions to be monetized. I think, as was mentioned, that the insurance data can even provide support for the real estate companies to go to their investment committee to make the case, rather than saying we're just paying for premium, right? I think those are really good tips. I don't want to miss any of the questions submitted online, so let me go for it. The first one is go to Kevin. The question is, I appreciate that it takes a wide range of activities to manage climate risk, but are you able to share which action had the traction with AXA as the insurance company in terms of premium reduction? And also alternatively, how much of the savings can you attribute to upgrading operating practices or?
Sure, thanks for that. So first, I want to clarify that the AXA case study didn't necessarily break down what each component would be in regards to the contribution to the insurance premiums. What we did do, we did invest about 3 million Hong Kong dollars in 2024 to our flood resilience measures, and then we've allocated another 5 million for this financial year. So you could say and look back at and say that, you know, the floodgates, the increased in cleaning and so forth that we did with the 3 million is actually what led to the improvement in our insurance premiums. In the end, the key driver of that insurance premium reduction was being able to quantify or at least estimate how much we've reduced risk by. So I go back to that same example of it's not enough to say we've installed 10 floodgates, right? How high are these floodgates? How much water can it hold back? And what are the assumptions that we made, right? So we know when the maximum rainfall was, the intensity, and for how long. So we're able to quantify that amount and say, hey, this is what's been done. The second key quantification was really about the drainage system. So it's easy to say, oh, we've cleaned out the drains and made it more effective. But we were able to monitor, measure by changing the design of the grate on the drain. We were able to improve the efficiency by 150%. So again, that's, you know, that's more than 2 times improvement in regards to how much water we can channel away as well, and being able to communicate from that particular perspective. I don't have a breakdown of how much this has tied into that premium reduction. I think the last point on here is that there are some things to do with the standard operating procedures, which I mentioned is about cleaning, and that from the insurance perspective, they told us that it's just making sure that, you know, we are on top of these particular issues and that we know how we will respond and let people know our approach to that response as well, so that they have comfort in knowing this issue won't occur again.
Yeah, no, I think that's really good details you shared, Kevin. I think the other one is you must check with AXA in terms of what are the actions will trigger them to consider the price differently, right? I mean that's what I mentioned about the understanding from each other. So it's not only they understand you, but also you understand how your insurance works.
Yeah, it's that alignment of, it's that stakeholder alignment, right? What matters to insurance side and communicating that way and going from there. So absolutely, alignment of expectations.
Right. Perfect. The next question is the nature risk data is becoming more readily available and sometimes even publicly free. However, the mapping the exposure to specific company's location or exposure can be challenging. The questions go to Zurich in terms of have you got your own proprietary data sets to match with the company's exposure, or how you deal with that mapping exercise? Candice?
Thanks for the question. It's actually pretty complicated. Zurich Insurance map risks to company exposure using proprietary data sets and client-specific mapping. Our climate hazard data set actually cover different time horizons and various climate scenarios and global coverage, and helping business analyze exposure to their assets, suppliers, and critical infrastructure. And we're providing customized risk assessments and supply chain vulnerability mapping, which is very tailored to our client. For example, even you have the data for a specific location of a building, actually the risk exposed to the tenants on the ground floor and for the tenants on the 20th floor is very different, right? So it relies on our underwriters, our risk engineer, to tell the risk, to understand the operations and infrastructures of our clients. So that's why they advance our analytics and geospatial tools and enhance our accuracy. And additionally, long-term exposure forecast for 20 to 50 years developed by Zurich client change team will help client understand current and future impacts from natural perils on their sites. So this will give us a very comprehensive approach to understand the risks and build the data set. So in short, we're using external data, historical data from our internal claims, etc., together analyze with different tools.
Yeah, no, I think data is quite important, but also communication and alignment is also key. We have like 4 minutes left, so I want to go through the last questions or last 2 questions very quickly. The next one is in terms of climate resilience, Hong Kong compared to other locations and countries, are we lagging behind? Where we are? I will go for any panelists who have a view on this.
Wei, I'm going to just have a quick comment on that, if you can hear me, hopefully.
Yeah, go ahead.
Okay, we have seen where, you know, we are lagging to a certain extent already, but you know, certainly following on from the work we did with Link and Calvin, you know, we've had a great response. So I think there are a lot of companies, a lot of real estate companies who want to do something, trying to do something, and that will only increase. So this will snowball, this will improve. I think it's worth pointing out, though, that in other countries, a challenge that they face is that in the exposed areas, that's where we see the increase in value at risk. Because if you look at, for example, parts of Australia, Queensland, you look at the Gulf states in the US, California, that's where we see demographic movements. That's where we see people moving to and developments there. So there's more value at risk as the actual risk from climate change is increasing in those areas. So they got a specific problem. But again, we've seen from our conversations with developers, investors in Hong Kong that they want to get in early. Again, I mentioned the stake decision at level. They want to make decisions early. They want to do the adaptation work at an early stage to see should they develop or should they invest in a certain area or not.
Yeah. Okay.
I want to just add to that. I think Ed is right. I think the private sector in Hong Kong is moving, and it's moving faster than probably anywhere else in the region. But I think the government is lagging, and I think that's also partly why the private sector is moving faster. I think, but I believe that actually, you know, to be fair to Hong Kong, all governments are lagging with regards to adapting for sea level rise, because we haven't accounted for these ice dynamics, and I cannot underscore how fast they're moving. And so we're all a little bit behind on that, and that's why we're lagging. The other thing is that, you know, I believe when Calvin and everybody else on this call do their stress tests, we're actually using the high end of the range of the worst case scenario. Whereas our government in Hong Kong is actually only using the medium of the range. So it gives a very different number, right? The high end of the range could be is over 1 meter of sea level rise, for example, whereas the medium of the range is like maybe, you know, 0.6. Right. So I think, you know, picking your ranges and so forth will get you to the right place. There's no point if you can't see the risks. But we all need to step up on that.
Yeah. I think my final comment is a cross-section, cross-industry sharing is never easy. I think we're having this right now. It's a very big step. And you see Link and Access doing actual risk sharing already. Very quick, 30 seconds answer. Hannah, Hannes, what are some of the key strategies and the resilience funds that the insurance company are implementing or using? Maybe that's a tricky question. I don't know. Is there anything you could share from Zurich point of view?
Sorry, I just got stuck a little bit just now
Okay.
for the question.
The question is the key strategies and the resilience fund, just from the investment point of view, on what the insurance company implemented, whether they use this for nat cat exposure reduction. Is there anything you
Okay. Yeah. We have the investment strategy, like to invest in different assets that support mitigating the natural disaster. So we do it through our investment team to look at the strategy of the fund, which will like reduce the carbon emissions and to support the transitioning of different companies directly. So our aim is to achieve net zero for our investment portfolio by 2050 also.
I think all the major insurance companies doing that, and I'm sure they will do more, is how that links with the other part of the business.
And also, actually, we have a fund to sponsor some pilot product, which support the resilience of different solution product for our clients as well. So we are trying to really mitigate the natural disaster.
Good. So you basically start to link those two kind of risk mitigation and also the fund investment. Perfect.
Right. Thanks.
We really run out of the time. Thank you for the panel, and I hand over to Tuan.
Thank you, Jingwei, and all our speakers today for the excellent conversation. Clearly, the physical risks are increasing, but it's comforting to know that the insurers want to see action from their clients, and the asset owners also want to preserve their value. So, there are opportunities here for alignment and collaboration, so that as we embark upon typhoon season, we don't have to enter it with too much nervousness. Finally, before we close, you can find more information on HKGFA, including our future events and webinars on our website and through our social media. The team at Marsh would also like you to help them better understand your approach to climate change adaptation through a short survey, which you can access via the QR code here on the bottom. So once again, thank you all very much for joining us today, and have a lovely day. Thank you.
Thank you. Bye-bye.
Thank you.
Thank you.
Right.